Welcome to another episode of Quest for Twice. Today is October 30th, 2023. The earnings season started about 2 weeks ago, and many important companies in my portfolio provided the earning updates. So today I'm going to cover many of them. The first one is Kinder Morgan. Kinder Morgan reported a fairly benign and boring earning update. So really, there is very little change in terms of full year outlook. The market cap currently is about $38 billion at $17 per share. And no update to its full year DCF, $48 billion, and capex, $2.1 billion. Its forward dividend is about 6.6%, and the EV over EBITDA is about 9. An interesting update was the amount of stock buyback. So in this year so far, it spent about $472 million to buy back shares at $16.86 per share. So slightly below the current stock price. Equifax also reported the earning. Its quarterly revenue was up 6.5% on constant currency basis. That's a slowdown from a multi-year CAGR of 9%. Its organic non-mortgage revenue was up 7%. Total non-mortgage revenue was 11% increase from 1 year ago. That's an improvement from second quarter, where the total revenue was flat year on year. The main issue here is the mortgage headwind continued. So there was a 34% fewer mortgage increase in 2023. Another update was negative, although its third quarter EBITDA margin was 33%, very similar as the guidance provided at the beginning of the year. But the management revised its fourth quarter EBITDA guidance. So its fourth quarter EBITDA margin now is 34% versus 36% guided 1 quarter ago. That's because of the continued headwind from mortgage market. Now let's take a step back and look at its growth drivers for the medium-term future. So the cloud transformation is completed for its EWS segment. The USIS segment will complete at the end of this year. The company delivered many new products and innovations. Its vitality index was 15% in the last quarter and 14% in the second quarter. That's above its 10% long-term goal. For the workforce solutions, the company continued to add a number of contributors. At the end of third quarter, that number is about 2,900 contributors versus 2,500 1 year ago. Its number of records at the end of the third quarter was 163 million, comparing to 146 million 1 year ago. So the company is still adding more data to its EWS database. On the M&A side, now since early 2021, its run rate revenue from acquisitions now is about $610 million. That's from the acquisitions of Logic and Medicator 1 year ago, and in the recent quarter, it acquired BVS in Brazil with $160 million of run rate revenue. The management mentioned that they plan to pause with the major acquisitions to reduce debt and digest the acquisitions. Let's take a look at my original investment thesis. At $161 per share, its enterprise value is about 25.6 billion. Give it EV over EBITDA about 15.2. That's using this year's estimated EBITDA. That's with the very high margin mortgage business severely depressed. So it's highly likely that the future EBITDA growth will be over 12%. I see no change to its wide and growing mode. So the thesis is to buy a high quality growth company at an attractive price. In terms of threats, the mortgage market continues to decline due to the high and rising interest rate. Recently, there was a significant rise in the 10-year US Treasury bond yield. That's pushing the mortgage interest rate close to 8%. On the other hand, mortgage business will hold less sway with its diminished revenue share. The management mentioned that will be about 15% in the fourth quarter. So the main threat to the remaining business is really a recession. The management mentioned 54% of its revenue is recession resilient. So I do look at that as a temporary setback if that happens, and will be presenting excellent buying opportunity. So I don't see any major change to my investment thesis. I'm happy to hold my current position and will consider adding more if its stock price drops further. Now let me switch gear and talk about the mega techs. Google reported fairly decent third quarter results. The main problem was its cloud segment, with a subdued growth at 22%. That's a significant deceleration from the previous quarters, with the numbers I provided on this slide. The good news is its service segment, with 11% revenue growth in the third quarter, acceleration from 5% growth 1 quarter ago. And also, its operation margin for the services segment is holding steady around 35%. Now let's look at the valuation and the risks. The EV over ops income has reverted to mean with a big price increase in this year. Although its advertisement business has resumed growth, but it'll be subject to recession if that happens. With the current 10-year Treasury yield around 5%, and its valuation is about the historical average, I don't see compelling reason to add my position in Google. Now let's look at Amazon. Amazon's recent quarter also saw sales growth in 13% year-on-year. That's an acceleration from previous 6 quarters. The management gave a guidance of a 7 to 12% growth outlook, with a little bit currency tailwind. Its AWS segment grew 12%. That has stabilized about the same as second quarter growth rate. That's significantly less than previous quarters, but at least it's not getting worse. As shown on this figure, all other segments are either improving or stabilizing, with a bright spot in advertisement with over 20% year-on-year revenue growth, and its third-party sales growth around 20%. That's also very healthy. Now let's look at the margins. Its operation margin was 7.8% in third quarter compared to 2% 1 year ago. That's really helped by cost reduction. As shown in the figure on the top right, the COGS margin has reduced slightly compared to the last couple of years. More noticeable margin improvement comes from fulfillment cost. It had continued to decline from a peak in the summer of 2022. So Amazon is making good progress to digest the overcapacity in labor fulfillment center and the distribution built up from the pandemic fast growth. On the other cost, its technology and marketing cost went up 9% year on year. That's a significant reduction from previous quarters. On its AWS segment, its ops margin bounced back to 30%. That's after 4 continuous quarters of below 30%. So that's a fairly significant revert to mean to 30%. So overall, the picture is revenue growth has stabilized and its margin is improving. But what about valuation? Its EV over gross income is about 5.1 at $128 per share. That's a reasonably low, except 4.1 at the end of 2022. So Amazon's stock price is, I would say, slightly undervalued. Lastly, let's look at the Meta platforms, aka Facebook. Its third quarter sales went up by 23%. That was surprisingly strong. Just put in context. The second quarter sales grew 11%, and the first quarter grew 3%. So 23% was excellent growth. To make the good news even better, its ops margin was 40% versus 20% 1 year ago. That's driven by significant cost reduction in marketing cost, down 24%, and constraint on the R&D expense growth, which was flat year on year. Meta Platforms is still spending tons of money on Metaverse. So with the operation loss $3.7 billion in the third quarter, same amount of loss as second quarter. The management gave an updated guidance about $88 billion of expense in 2023. However, the management anticipated the expense will increase significantly to the range of $94 to $99 billion next year. Similarly, capex this year is about $28 billion, but that will increase to about $30 to $35 billion in next year. So if we look at the valuations, its EV over EBIT is about 19.3 at $295 per share, comparing to 8.5 at the end of last year. So it was really a screaming buy at the end of last year. Now, I would say it's fairly valued. Its cash flow yield is 8.7% despite the heavy investment in R&D and the metaverse. Its cash flow is fairly healthy. Should still have a significant amount of money left for share buybacks after paying capex. But easy money is already being made. I see no reason to get back into metaverse stock at this stock price point. This concludes this episode of Quest for Twice. Until next time, happy investing.